Well, hello everyone, and welcome to the latest edition of Conversations with a Pro Trader. I'm your host, Greta Wall, and with me today is T3 Trading Group Senior Trader, Derrick Oldensmith. Derrick, thanks so much for coming back today.
Hey, Greta, it's great seeing you again. Happy to be here.
Yeah. All right. So you know my first question. We don't need you to introduce yourself. We know who you are. So how would you grade your week of trading so far? It's a Wednesday out of a 5-day trading week. So give me that grade on a typical school grading scale, 8F, and why?
Sure. Um, overall, I've been trading really well for a while, but at the end of last week, really through this week, I made a mistake. I violated a rule. I'm in a position I shouldn't be in, and it's starting to turn into a fairly nasty loss, though I'm still in it. This chewy position that I'm in, I'm long, just keeps getting absolutely pummeled.
Hmm.
I violated a rule. I made some mistakes, down more than I really should be in the position. So just for that alone, I can't give myself a great rating for this week.
Hmm.
Probably I'll give myself a C or a C minus. Hate to
Hmm.
say it, but I got to keep it honest.
Yeah.
The key to success in this business, and I talk about it all the time, is creating a rule set for yourself and then having the discipline to follow it. And I can also tell you from working on my own trading and working with and managing just so many traders over the years that the number one reason that people fail in this business, the number one reason that they're not successful is because they violate their rules. And that usually happens when it comes to the risk management rules that they establish for themselves. And here I am, been doing this for 15 years or so at this point, professionally, and I still find myself occasionally, not too often, I'm glad to say, but even occasionally is too often,
Yeah.
making mistakes, and those mistakes can be really damaging. The key to success in this business is to be confident with your rules, confident with the risk that you're putting on any trade, confident that you can afford it. And I'm not, down a number that is something I can't afford or that is necessarily a massive detriment to my account or anything like that. But
Hmm.
taking any loss, and this one is starting to become a little bit outsized, specifically because you violated your rules, is a terrible loss to take. It's not the right way to trade. It's not the right way to be consistently profitable. And here I find myself in a situation where I'm doing that,
Hmm.
and it is what it is. I just got to relearn a lesson that I've learned previously, which is also not something you want to do. It's okay for traders to make mistakes once and learn from them. It's actually part of the process. It's part of the learning process. But at
Hmm.
this point, I have been trading so long that I have probably made every mistake that you could possibly think of in trading. So I
Hmm.
have no excuses to make any mistakes at all going forward because I've made them all already, and I should have
Hmm.
learned from every single one. Yet every once in a while, you get in your head, you get a little bit too loose, and it's usually the same thing with me. Um, I'm doing really well is usually when I make my mistakes.
Hmm.
Coming off of a mistake, I could tell you there's no shot that I come in and I make a mistake tomorrow or next week or next month. It's
Hmm.
when things are going really well for me for a significant period of time, which they have been. I've been trading really well all year. I'm having a phenomenal year,
Hmm.
trading wise, phenomenal year P&L wise. Um, my as I came into making this mistake, my P&L was at highs for the year, and here I am unnecessarily giving back some in a loss that I shouldn't take.
Hmm. Okay, so you say this mistake was you violated one of your key rules in your own strategy. So what was that rule? What happened with this trade, and how are you managing it to get yourself out of it?
Don't swing positions that are against you. Is the rule. I kind of preach
Okay.
it all the time. Holding positions overnight is a risk.
Mm-hmm.
Always, it's a risk. If you're holding positions overnight, you have no idea what news could come out. You have no idea how the market could gap, what news could affect that stock that you're in, or what news could affect the market as a whole.
Mm-hmm.
So what I preach is I'm a big believer in swing trading. The
Mm-hmm.
longer that I've been in this business, I would say the longer my average hold for my trading has become. I started as a pure day trader. Now I hold positions for days, weeks, months at a time. I also
Mm-hmm.
still day trade every day. A lot of what I do is I actively day trade around a core position to pull out cash flow from it on a day-to-day basis while I'm holding that core position for that bigger move based on the daily chart that I'm looking at. But I like to do that from a win-win situation. So a lot of my swing trades will start as day trades. I take a trade that I like. It's on the side of the daily chart. I'm always trading in the direction that the daily chart is telling me that I have an advantage. I find the small time frame execution. It closes well in my favor. I'm up 2% on the position. I sold 50 to 75% of the position throughout the day to put some cash already in my pocket. And I say on this last, 50 to 25% of my position, whatever it is, I'm up 2% on it on a closing basis from my entry point. I've already booked profit in, and on top of that, I'm going to keep this position overnight. I'm going to risk giving back open P&L to potentially make more. And that's the money that I love to risk. I love risking money that I've already made. I hate risking new money. I hate the idea, though it's a natural part of trading, I can't get away from it. I hate the idea of getting involved in a trade for the first time, pressing that button, and maybe I just bought the absolute high of the day. If you're trading long enough, I promise that will happen to you. And I could take just a direct loss of my own money. That's the money that I hate losing. I'm very tight about that. I keep my risk really tight when it comes to that stuff. But I could be up, you know, really big money in positions, and I'll say I'm willing to give back every penny that I've made in this thing in order to potentially make more. And that's how you go from, being up $5,000 in a position to being up $50,000 in a position. I might not risk 5,000 of my own money right away, but if I'm up $5,000 in the position, I'll risk that entire 5,000 that I'm up to see if that 5,000 can become 50. That's the money that I want to risk. And by closing out and keeping positions overnight where you have that profit cushion, if the position is 2% in my favor, plus I've already booked some money, and now the whole market gap's against me or the stock has bad news, I'm primarily just going to be giving back the money that I've already made, as opposed to this Chewy position. Just as an example, um, yesterday I was talking to the team that Chewy could potentially give like an RDR or red dog reversal on the daily chart because it's really oversold and snap back through the previous day's low and close better. And that's exactly what happened. I was already in it from a previous day, so I was just kind of making a little bit of money back at that point. And then it got downgraded this morning, and it just gapped down big. It gapped down to new lows, and closed off. It was already down like 4% before Jerome Powell even started speaking, and then obviously he wrecked the market further, and the thing just went down even further and closed on lows. So I did the complete opposite of what I preach. What I preach is put yourself in the win-win situation and then go for reward maximization. If you're holding positions overnight that it's against you, it's a lose-lose situation. And then you find yourself in the situation that I'm in now, where it's like, okay, I'm down this amount of money. Stock's really extended to the downside. I want to continue to manage this position because I think I can make some money back. But that is the wrong way to trade. Traders do this to themselves all the time. I see it all the time. The position's against them, and they're praying like, oh man, I just want to get back to break even on this trade, and I'll liquidate it, and I'll never make this mistake again, or whatever. But what you're doing there is you are inherently risking potentially unlimited amounts of money to make nothing. It's the opposite of what you need to do. You need to be limiting your risk and leaving your reward potential as unlimited as possible. That's what successful traders do. Traders that fail, traders that take losses that they shouldn't be taking, they put themselves in lose-lose situations and try to manage a lose-lose situation. And you can't do that. So circling back on everything, trading is about having rules and then having the discipline to follow them consistently over time.
All right. Okay, let's get to the news of the day. The Fed decision. You mentioned it briefly there. Central bank, as expected, leaving interest rates unchanged. That wasn't a surprise at all today. But the focus was on the future. What's the Fed going to do moving forward? And they released a new dot plot today, and that shows one more hike this year, either in November or December. They haven't said which meeting. They haven't laid that out specifically. What was your reaction to today's meeting?
I didn't think that was a surprise. I think that we had already been, the market to some degree had already been pricing in one hike into the end of the year.
Mm-hmm.
My expectation coming into this meeting was actually, I thought it was going to be more of a non-event than it actually turned out to be.
Mm-hmm.
And interestingly enough, this is the first Fed event of this calendar year where the move that we had in the market today exceeded the implied move in the S&P. The
Mm-hmm.
S&P 500 implied move today was 0.67%, and I think we closed down a bit over a percentage point. So this is
Yeah.
the first time that we've seen this entire year where the move has been bigger than it was expected by the options market, and the realized move has been steadily decreasing since the height, basically at the market bottom in like November of well, the bottom was in October, and the last really big Fed move that we had was in November 2022. So they keep becoming more and more muted. The CPI days have been more muted. The Fed days have been more muted, and that was kind of my expectations coming into this one. And when they kept interest rates on hold, that was not a surprise. When they said that they might, increase again this year, I think it was 12 Fed members are seeing an increase still, and 7 aren't. I might be a little bit off on that number. Uh,
You're
Not
right.
necessarily a
12 and 7.
surprise.
Mm-hmm.
12 and 7.
Yep.
I think the surprise a little bit was just kind of in the hawkishness of that dot plot, I think, into 2024, probably more
Yeah.
than anything. Plus, the probably someone expected hawkishness of Powell's language at certain points during the press conference is
Mm-hmm.
what really sold us down. So I was not expecting this move to happen today to the degree in which it happened. I really thought we were just going to get a bunch of volatility in no direction.
Hmm.
That was wrong. But it didn't seem dramatically surprising to me either. I was,
Hmm.
he's always hawkish. He's always leaving the door open for him to further increased interest rates. And also, how many times have we seen them delay the cuts? Remember when the cuts were
Yeah.
supposed to start happening in the middle of this year, and
Mm-hmm.
now we're still raising into the end of this year. So this has been something that's been ongoing for a year now, where they keep just pushing it back, pushing it back, pushing it back, higher for longer. We're staying the course. We're getting down to 2%. So why is anybody surprised about this?
Hmm. That was a question reporters pushed Powell on during his press conference, saying, you guys keep updating your summary of economic projections, your dot plot. You update it every single time, and you're just pushing cuts further, and you're pushing cuts further back and adding more rate hikes. Apologies for my dogs. Um, and so the question was, how can we really trust these projections if you guys just keep changing them? Do you think they're trustworthy?
It reminds me a little bit of the sell side analysts who have been calling for a recession since October of 2022 that hasn't yet materialized. And it seems in some way the most bearish part of the Fed meeting today was that the economy is too strong, right? That's kind of what they were talking about. It's like, yeah, we have to keep interest rates higher for longer because this economy is way stronger than we expected. And the fact of the matter is the interest rate hikes have not deteriorated the economy to the degree that the Fed, I think, thought would happen. Um, there's a lot of data that shows the way that inflation has come down, the amount that it's come down, you can only attribute a relatively smaller percentage of that to what the Fed has actually done. Most of it is just supply chains coming back online. Obviously, the increase has helped bring inflation down, but that's not been the main driver here. So I think that these sell side analysts, which they're not dumb people, and Jerome Powell and the Fed, they're also obviously not dumb people. I think that just everyone thought that the hiking that's been happening in this hiking cycle would drive us into a recession, and that would cure inflation. And then once we're in the recession and inflation is down, well, then they can cut rates again. And it's just not really playing out that way. And I think it's just because the consumer, really both the companies that are out there, the big companies, the S&P 500 companies, and most consumers just were in really, really healthy financial positions as we started to go into this interest rate hiking cycle. Because when if you look at a chart of the hikes on this interest rate hiking cycle compared to others historically, it like blows the other ones out of the water. There's been others that have been longer in duration, but there has never, I think, in modern history been a situation where we have hiked interest rates so many times so fast, and also yet we're still not in this big recession that everyone's looking for. I would argue that there have been a lot of mini recessions out there, and probably certain sectors. We probably have seen a little bit of a Silicon Valley recession. We're probably seeing a little bit of a recession in commercial real estate. So little areas here and there have gotten pushed away, but the consumer is still fine. Unemployment's at like 3% or whatever. So how are you going to have a real recession and really bring interest rates down to 2% when everyone is working and everyone is, for the most part, locked in still to 3% mortgage rates?
Yeah. Jerome Powell did tell reporters today that a soft landing is not the Fed's baseline forecast. He said, it's not our baseline. We don't necessarily expect that to happen, but that's our goal. It's our primary objective. He also, as you mentioned, said the economy has significant momentum and highlighted the surprising strength of the U.S. consumer throughout this hiking cycle. A lot of that consumer strength, according to analysts, is based on the excessive savings that were left over from COVID. And again, of course, the low mortgage rates, et cetera. So now the banks say, Bank of America, JP Morgan, say the excessive savings are running out. They should be kind of out as of now, if not by the end of this month. Student loan payments are resuming as of October 2nd, I think. I think that's the due date on mine. And credit is tightening significantly, but people are putting more and more on their credit cards as rates rise. So do you see that momentum in the consumer slowing rapidly because of all these things that are starting to compound?
Slowing, yes. Slowing rapidly, I'm not sure. You don't want to underestimate the American consumer's love of consuming, of spending.
Yeah.
They'll, especially again, everyone's still working. You still have 3% unemployment out there. So people have a paycheck, they're going to be spending money. Now, they might adjust their habits a little bit. They might see that their belt is they have to tighten their belts a little bit. Maybe instead of paying for Netflix and Hulu and Amazon Prime and Disney Plus and cable, they say, I'm gonna only pay for one or two of them a month, and I'll rotate around based on what show I want to watch and save a few dollars that way. Or maybe they'll go to TJ Maxx instead of Target to save a few dollars that way. Or they'll get cheaper dog food from Chewy. I got the position disclosure up there, right? Talk
Yeah.
my own book. They'll get cheaper dog food from Chewy than from their local store in order to save a few dollars there. So they can adjust their spending habits a little bit, but I don't think that you should totally count out the consumer until you kind of see the white flag being raised and the whites of their eyes with the actual data coming out, and we're not seeing that yet, really.
What do you think it would take for the Fed to stray from the projections they laid out today? For those only 2 cuts in 2024, higher rates in 2025, higher rates in 2026, etc.
Real rates coming down primarily because inflation's going down. However that happens, whether it's because it continues to come down naturally and there's some concerns that we might actually see a little bit of a spike in inflation again right now, or because a real recession actually does hit at a certain point that drives inflation down and enables them to be able to cut. Otherwise, I mean, he's been saying from the beginning higher for longer. He's been saying from the beginning we're going to keep interest rates here until we're at 2%. So we finally are seeing an uptick in inflation the last couple of months. You're seeing oil back to highs from certain points in 2022, and you're expecting them to not hold interest rates while everyone's still working. The economy's still in decent shape. Again, to me, it seems a little bit obvious, but I guess the market was taken by surprise on some of this stuff today.
While we're on this topic, I have a question of how you traded the initial market reaction, and then the Fed, the Powell bounce up and down, and then of course the plummet there after Powell. And we got an audience question about this too. John asked, how could you have traded the market beginning at 2 p.m. Eastern? So what is your kind of trading focused right around or your strategy right around when the decision comes out, and then of course the volley during Powell and then after Powell.
Sure. So I traded this one actually much less aggressively than I typically trade these Fed days, and I did that for a couple of reasons. One is I missed a little bit of the morning session because I was at the doctor's office. I'm flying to Las Vegas tomorrow, so I'm not really going to be able to manage my positions in the same way because I'm speaking at the Market Mind Summit in Las Vegas. Hopefully some of our viewers will be there. I'd love to meet people.
Yeah.
So I just and the third reason was because the implied move was smaller, and I thought that this was going to be a little bit of a non-event, which I think is what the market thought also. It's why the implied move is smaller. So I thought that we were going to get volatility and no direction, and that can be really tricky to trade. The Fed moves, the CPI moves, they're easier trades when you get a trend off of them. And we didn't get a trend the last couple of times around. We got a lot of volatility, but no real direction. And I really thought today was going to be similar. So for a variety of reasons, I chose to be a little bit more hands off today than I typically am on these movements. But I was still involved. I was still trading, albeit a little bit smaller and a little bit less aggressive. And I was still communicating with my team of traders that I work with through the ProDesk virtual trading floor. 2 to 2:30, the expectations were not expecting very much at all. The first thing that I always encourage traders to do on these news events is start by paying attention to the starting point of the market, meaning 2 o'clock, the Fed drops their statement. 2:30 is when Powell is going to be speaking. So you're going to get an initial reaction at 2 o'clock as you get a kind of a deluge of data all at once. We see if they increased rates or decreased rates or did nothing. And obviously in this case, they did nothing. And the market's going to have an initial reaction. And, a lot of times the initial reaction is a fake reaction. Then you go the other way. Some traders swear by the fact that the first move is always a fake move. I don't, because I've certainly seen situations where the market, some of the biggest moves I've ever seen have been when the first move actually is not a fake move, even if it's much lower probability situation, happens much less often. If that does happen, if you get that first move and then you just really trend in that direction, a lot of times that turns into a really big day in upside or downside. But the first thing I always want to pay attention to is where did we start? So the SPY, which is what I'm constantly staring at along with the Qs and the IWM, just the ETFs that represent the market, basically started at 443 spot 50 today. So very broadly, if we're trading below 443.50, I'd rather be short than long. If we're trading above 443.50, I'd rather be long than short. What that does is it takes away me having to, in real time, interpret what Jerome Powell is saying and what the Fed is doing. And I'm trading based off what how the market is interpreting what the Fed is doing and what Jerome Powell is saying. And again, it's very simple. This is the price we were trading at right when 2 o'clock hits. If we're below that, it's more bearish than bullish. If we're above that, it's more bullish than bearish. And I just would rather be on the side of kind of the winner. And if we lose that starting point, then I need to take a step back and kind of reassess. So, we immediately down ticked off 443.50. And then that becomes the first spot I'm paying attention to. If we can really clear above 443.50 / 444, because 444 was intraday resistance today, then the bears have lost the opening control that they gained and the bulls are regaining control. Now, with that said, the period of time between 2 and 2:30, we have not been getting any directional movements from the market in quite some time. The directional moves from the market have all been coming post press conference, 2:30 and on. So I don't want to be doing too much these days between 2 and 2:30. It's like, okay, the initial move is down, it's bearish, but we don't really know yet because Powell hasn't started speaking. He hasn't answered any questions yet. I'm taking note of the fact that we're breaking down, but we didn't get any immediate follow through. The first 5-minute bar was straight down, then we consolidated for 10 minutes, and then we actually started to break higher, and we broke that 443.50 very briefly. We tailed above it, we ticked above it a couple times, super quick, but couldn't hold above, and then we were immediately back below, and the bears maintained their control. And that is when we hit 2:30. So we were almost kind of back at that neutral point or just below it when 2:30 hit. And,
Mm-hmm.
I'm listening to Jerome Powell on TV. I'm watching in the virtual trading floor where we're getting all the highlights posted in there. I'm looking for any very key specific clues that could be something that he says that's particularly hawkish or dovish or that's a surprise. Because again, it's the surprises that move the market more than anything.
Yeah.
And he just took a very hawkish stance on things. So once we broke the initial movement low, which again, so we started at 443.50. The first 5-minute bar low dropped us $2 to 441.55. Let's just call it 441.50. And then we broke that 441.50 at about 3 o'clock while Jerome Powell was speaking. Once that opening low broke, you kind of knew it was on for the bear side of the market.
Mm-hmm.
And we basically trended down from there on. And we'll see how the market interprets things tonight. It oftentimes, not always, but oftentimes the day after the Fed day is actually the better trading session. The Fed day, market, the robots are trying to figure things out. You get quick spikes in multiple directions. It can be a little bit tricky. The bigger money managers, they're not making their decisions at 2:31. The second Jerome Powell says something, they're going to spend tonight and they're going to reread the press conference. They're going to digest the information. They're going to see, how did this affect the dollar? How did this affect interest rates? How does this affect how my fund is positioned in the market? And then they're going to spend tomorrow adjusting their portfolios based on their new thought process that came from today. So a lot of times, actually, tomorrow is the better trading session. And again, very often, though not always, the day after a Fed day is a trend day. And that's a day that you can take advantage of just by being a trend follower.
This is not your first Fed hiking cycle that you've experienced as a trader, whether, we're cutting or hiking, really, but hiking because that's what we're doing right now. How different is the market action in relation to these Fed days? How different is it than previous hiking cycles, if it is, or if it's not?
Sure. So I've spent most of my career, and I basically got started in 2008. I spent, and I started with T3 in 2010. I spent almost all my trading career in an environment of extraordinarily low rates. So I actually have not seen too many hiking cycles over the course of my career. I dealt with the hiking cycle that came in like 2015. There was a little bit of that. And then, and that created like a 2-year sideways market. Like if you look at a chart, like the second half, I think, of 2014 through like the second half of 2016 is basically just one big sideways range. All of 2015 was a sideways range. And that little hiking cycle we had there created a bear market in the average stock, but not a bear market in the S&P. I think that was the year where the S&P had like a 19.5% pullback, and 20% is technically a bear market, but the average stock was down 35%. So I would still view that as a bear market, though the history books won't. And then we had the end of 2018, where we had a quick, tightening period. Powell increased interest rates pretty briefly, and the market was getting smoked in November, December of 2018. And then Powell was put under a lot of pressure and completely flipped the switch. And that's when we had that like Christmas Eve bottom, I think it was, in 2018. And then, Powell dropped interest rates and the market just immediately ripped all the way back. And, we resumed approaching zero interest rates. So I've spent most of my career in those periods, and I've never seen anything like this. And I don't think no one's ever seen anything like this. Even if you've been trading, if you're old enough to have traded through the 1970s, you didn't see even back then a period of time where we were hiking in at the speed in which we were, but the economy stayed so strong. So every situation is unique. It's very important to know and to study your history, because you can try to learn from it, and you can try to take like these somewhat similar situations in the past, what happened then, but what's the new information from this situation, and how does it change the market? By all accounts, we should be in a recession. By all accounts, the sell side analysts should be right, and we should be at 3,200 in the S&P. But the fact of the matter is, the consumer has been very strong. The economy has been very strong. GDP has been growing, and the market has been trading great. And there's a lot of market dynamic influences on there also that we pay attention to that have been helping to hold this market up and to dampen down volatility.
Mm-hmm.
So again, each situation has been unique. I've been really nervous about this period here as we're like kind of in September, October, once we got past the September options expiration period, that it could create weakness into the second half of this month, which
Mm-hmm.
after today's trading session is certainly looking a lot more likely. I
Yeah.
hope that answers the question.
Yeah, yeah. Well, that leads me right into my next question, which is that historically, the final 10 days of September are the worst stretch of the year for stocks. So, what's your strategy for this, weak time in the market as you move
Sure.
forward?
So I started really kind of waving a warning signal again with the people that I work with last week that we
Mm-hmm.
could sell off into September options expiration and then post September options expiration. Um, this September options expiration that happened on last Friday was the largest September OPEX in history. And,
Mm-hmm.
those numbers just keep increasing because options are becoming more widely utilized, plus the zero DTE option stuff that is becoming a tremendous amount of the options market. I think something like 40+% of the average volume on a day-to-day basis in the entire options market is coming from zero DTE. So we had been just really, really tight. The VIX has been really low. Volatility on a close-to-close basis has been pretty dampened, even though dispersion's been really high, meaning that there have been big winners and losers in sectors and individual stocks, but the market, the push and pull has helped keep the market somewhat stable, especially on a closing basis.
Mm-hmm.
But when you get through that options expiration, it can open up the market to
Mm-hmm.
bigger movements. And that could be to the upside or to the downside. But when you combine that with the kind of seasonality here and where the market's been trading and the fact that inflation was starting to uptick again,
Mm-hmm.
I just started becoming very worried. I had initially called out for shorts at the end of July that worked really well.
Mm-hmm.
Honestly, perfectly picked the bottom in August. That worked out really well. And we've just been ranging out here in the back half of August and the beginning of September. And I'm just paying close attention to the technical support levels. We broke those big key technical support levels yesterday, but we snapped back intraday, and the S&P and the Nasdaq closed above them. And then today, because of the event, we lost yesterday's lows. So that's really concerning to me. I need to see the price action through the end of this week and early next week. I need to see if there's more supportive flows that come in similar to yesterday. I was very surprised that we turned around midday yesterday, but that's been the normal for this market. Part
Mm-hmm.
of what zero DTE options are doing to the market that we've never seen before is they're creating a tremendous amount of intraday reversals. And that I really started noticing it personally in the beginning of April when we had the big sideways consolidation in April and May. And then even on the way up, when we started breaking out in the second half of May, June, and July, you get these weak beginnings of the day that just kind of V bottom midday, and then we close up at highs. And a lot of that has to do with zero DTE positioning, but it also has the ability to be a compounding effect on markets if they want to use these leverage products to be able to push the market further in one direction or the other. And we saw that really briefly in mid-August. The market lost support, I think on like August 15th, we lost SPY 445. And it led to 3 really big sell days in a row where we would sell the beginning of the day, go sideways midday, and instead of reversing back up, which has been the primary playbook of this calendar year, we would see
Mm-hmm.
even heavier selling into the close. And for the people that are out there selling zero DTE options, if the market starts moving heavily in one direction or the other, the risk on those can be really, really traumatic.
Mm-hmm.
And then they're forced to cover positions really quickly, and it could just create a big snowball effect for the market. So I'm nervous in these couple of weeks. Big picture, I think that a range bound market is the most likely situation, but I think that there's a smaller probability of a really big move to the downside that manifests over the course of the next week and a half or so. And if we can
Mm-hmm.
get through September relatively unscathed and stay in this range, we'll probably stay range bound for October. And then there's a good chance that we rally hard into the end of the year as those flows become more supportive again.
Okay, let's go to some audience questions. Fernando asked if you have any rules for before or after economic events like the Fed decision.
Sure. So I don't actually have any specific rules around those economic events. What I don't do, I guess here's one rule. I don't put trades on like 3 minutes before the event and just gamble that we're going to move in one direction or the other. And that's similar to like an earnings report. I don't just buy or sell stock right in front of an earnings report and hope that I get lucky on the direction of the move. But I also don't, and a common question I get is, well, hey, if you know that there's going to be an event at 2 o'clock that maybe moves the market in your favor, maybe moves the market against you, should you just close out your positions and then wait and then potentially reposition yourself after the news? I don't do that either, because any trades that I already have on, they already have a game plan. I already know where my stop loss is supposed to be. I already know what my reward maximization game plan is supposed to be. So my plan is to follow my game plan first and foremost. You know, I already have this trade. My trade is based on rules. I got my stop loss in place. If the event happens to go against me, my stop loss will trigger and I'll lose the risk I was planning on risking anyway. And if the move happens in my favor, then I'll make the money that I was game planning for anyway. So I don't really do anything different outside of just being aware and prepared. And then I'll trade the event pretty often after it's already coming out and put new trades on or manage trades, or, you know, sometimes if I didn't do this today, unfortunately, sometimes if I'm long a bunch of positions like I am now, I'll look for an opportunity to short, you know, the TQQQ or, you know, one of those leveraged index ETFs as a trade, but that trade also helps to hedge me out. So that's some of the stuff that I'm looking for, but I really don't do anything specific, like, you know, close out all my positions into an event.
Okay, while we're on before we change topics with some other questions, let's stay on the Fed questions. Tate asked if Jerome, sorry, did Jerome Powell say anything during his press conference that you did not initially expect him to say?
No, because he always gets on there and he's super cryptic but slightly hawkish and leaves you know, open the possibility of keeping interest rates high for a long time or raising them. So to me that all seemed normal. I think that the thing that really moved the market, just very straightforward, is an increase in where they're expecting interest rates to be at the end of 2024, which I think like the Fed's median projection is 5.1% by the end of 2024. Yep. And the previous one was 4.6. So you got like half a percentage uptick. I'm going off memory.
Yeah. There. Yes, because they originally projected four cuts in 2024. Now they're down to just two. Yeah, quarter point cuts.
Right. So that makes sense. Half a percent, 4.6 up to 5.1 by the end of the year. I think that's pretty straightforward is kind of the main reason why we sold off. With all that said, I still typically do a good amount of post-Fed Day research. In the same way, like we said before, most of the bigger fund managers out there aren't making their decisions today. They're taking the evening to digest all the news and really study it, and then figuring out how they want to position themselves tomorrow. I do that similar as well. So I, for the most part, know what everybody else knows, just taking like, you know, quick first glimpse at the information as it was coming out. But I'll want to spend some time tonight really going through everything, digesting it, and trying to have a better understanding of what the implications are for the markets here.
As you mentioned earlier, sometimes the day after the Fed is kind of the bigger trading day than the actual Fed day. And so on that, Shane asked, would you look for support in SPY 435 tomorrow if we get there to look at longs? If we do, we should be around $8 extended below daily 8 EMA.
That's a guy on my team.
Yeah.
If he's asking questions like that, I love it. Yeah, so 435 is absolutely a spot that I would pay attention to. It's support on the daily chart from August. I'm looking at this on my other screen right now. There's actually a pretty broad support area between 433 and 435. I get a little bit nervous buying the day two, especially if it's a trend day down into a Fed day. I would almost prefer, if we're going to be that weak tomorrow and we're going to get down to, you know, 433 to 435, being a little bit patient there and waiting for Friday or for Monday, waiting for like that day three. And then at that day 3, if we can, have the market trade back through, so you're buying on the way up as opposed to buying on the way down, trade back through those levels, and you've got that $8 to $10 plus of extension away from the 80 EMA on the daily chart. So that's one of the ways in which I view more extreme extension on the big picture of the market, in conjunction with buying back through a support level, potentially after the market shook out those August lows. I would like that as an even better situation than just we're down $3 more tomorrow. We're $8 extended, but we know $10 plus extended is more extreme. So we could continue to further push, and you're buying on the way down, kind of hoping that 435, which is absolutely a support level, happens to hold in the face of, a weak period of time as the market's breaking down, and it can also be a bit looser again post OPEC. So I just think that we're potentially in an environment right now where wherever you think the market should stop on the way down, tack on a couple extra points to it. Because if this market is looser now, which I think it has the potential to be, you could see a further down or up move. So it's looking more like to the downside as at this point than you would otherwise.
All right, let's switch topics. IPOs are back all of a sudden over the past week. We saw ARM Holdings last week. We got Instacart yesterday, Klaviyo today. So a question from Vincent. He asked if you had any thoughts on the terrible performance of the recent IPOs, specifically ARM and CART. Bad seasonal timing, bad valuations, both. What are your thoughts?
Yeah, I was going to say IPOs are back, but not for long if they're trading the way that they're trading right now. CART was priced at 30, I think, and it ticked through 30 into the close today by a few pennies and managed to close just barely above it. ARM was priced at
31. Price?
31? No.
Price at 31. Yeah, they were like, I'm pretty sure. No, I wrote about this.
On that.
I'm going to look it up. 51. 51.
51. Okay. Yeah, 51. Yeah. So that ARM gave a pretty decent pop, and now it's at 52.40 right now as we're having this conversation. Yeah, I don't know. I mean, the investment bankers, they're not dumb. There's been zero IPO flow or secondary flow for the banks for quite some time. If they're worried about this recession actually coming in, but the market's been performing well, I think this is a great time for them to try to get some deals done and try to get some things to market and use that to test the waters a little bit. These IPOs are not going great, but I would also argue that they're not atrocious. ARM is still, albeit barely, above its IPO price, and CART, down 10% today, but just getting down to what the actual IPO price was. So, a lot of the times with these IPOs, they price them pretty well on the primary market, and then they kind of damage people on the secondary market. And that's been one of my big pet peeves for a very, very long time. This CART, as an example, they opened this thing up at $41 when they priced it at 30. That's a really big premium to the primary market. So they open it up at $41. If you're just a regular person and you think that this is a great company and you want to be involved, but you don't have a huge account at, whoever, I don't know who the lead underwriter was for CART, but you don't have a huge account at that big bank, you're not getting any of the syndicate flow on the primary market to actually have stock from $30 in CART. You can buy it at 41 when it opens. So there's always been a problem with that in my mind about how high they sometimes will open these things on the secondary market compared to the primary market. It's kind of a real racket. And that's why I always wanted those direct listings to be able to be better than they have been. Like when Spotify did its direct listing, like I love that concept of them just going to the market and not really using any of the investment banks, because I just don't think that the investment banks do anyone any favors except for their big account holders when it comes to IPOs. If they could have opened up CART at $41, that means they could have priced it at $41. That would have raised more money for CART.
How does that
Go ahead.
For just someone who maybe doesn't understand IPOs totally, how does that happen? Like, how do you price an IPO the day before at $30, but then nobody gets to trade it at 30. It opens at 41, up, $11 on the IPO price.
So they say it's based on supply and demand on like basically on the IPO day. So IPOs don't open up for trading at 9:30 like every single stock does. They will open up sometime after the market opened up. And I think that Instacart yesterday, as an example, opened up at about 1 p.m., maybe just a little bit before 1 p.m. So throughout that entire trading day, the market makers are basically taking in indications of interest, of supply and demand at certain prices to try to figure out where the stock should actually open for trading based on what they're seeing as far as, like, for lack of a better term, almost like market on open buys versus market on open sells. That's why sometimes you'll see, if you can actually see like the indications of where they think it might open, you'll sometimes with certain IPOs see that it's increasing the entire morning. So like sometimes you'll see like, oh, the IPO price is 30, it's indicating to open at 35, and then an hour later it's 36.50, and then an hour later it's 39, and the next thing you know it opens at 41. You can see that kind of almost happening in real time. So that's what they say it's based off of, but I don't understand if that's accurate, how you get to situations where they open up super high and then they just are immediately dropping the second the market's open because everyone's dumping. Somebody, in my opinion, somebody did a bad job there. And again, the only people that really benefit from a situation like CART that opened up at 41 and then immediately dropped and never saw anywhere close to that price again are the people who are the big account holders at the underwriters, at the investment banks, who get some of that deal flow. And they just bought the stock yesterday at 30 and they sell it today at 41. See you, William Jones. Thank you. And I don't know. I think that the whole thing is a racket. In certain situations, I also love trading IPOs. I traded ARM and I made money in it when it opened. CART, I thought, opened up too high. I hadn't done a ton of research on it. I didn't touch it. I didn't touch the one today either.
Yeah. All right. How would you describe the current market sentiment and action?
It seems a lot. The market sentiment seems a lot more neutral to me right now. Okay. One of the things that got me really bullish in the beginning of this year, and one of the things that had me calling for the breakout of 4,200 back in April and May, when it seemed like everybody was bearish, was because the sentiment was so poor and because everyone was bearish. And then one of the things that actually got me to flip my thought process at the end of July was that everybody was starting to become very bullish, and all our sentiment indicators were starting to show more and more greed, basically. And now in this area, it seems like we've come back down to just kind of much more neutral sentiment and more neutral positioning, which was the other thing. That the positioning went from extremely light and bearish at the beginning of this year. I think I might have been on with you when we had discussed, I think at the beginning of this year, that hedge funds were more net short than at any other point that they had been since 2011. That was also one of the things that had me bullish. If this market breaks up, those short positions are getting squeezed. They're going to have to performance chase the long side. And then at the end of July, we started to see the opposite. We started to see that the flow from the ball-based strategies that are out there that are basically leveraging up as the VIX goes down had become at the highest. It was in like the 94, 95, 96 percentile. I don't exactly remember where it was of being leveraged on like a 3-year look back. So we started to hit that point in the end of July where you're running out of people to kind of be able to buy. Here, now that we had the pullback in August into September, I think that both positioning and sentiment has become a lot more neutral, which is one of many things that potentially sets this market up for moves in either direction, depending on how we break. I'm still slightly biased to the long side on a bigger picture, but on the smaller picture, after the breaking of yesterday's low today, the technical picture has soured again, unfortunately.
Okay, so you've already talked, I think, about what we would say would be the worst trade you've had this week, that Chewy trade. So on the positive side of that, let's talk about the best trade you've had this week and what made it go well.
The best trade's everything else, everything else I'm just doing exactly what I'm supposed to do.
Mm-hmm.
I come in, I create a game plan for myself, I come up with different ideas, I execute those trades, and I let them play out. And
Mm-hmm.
I think that I can have great trades that lose me money, and I think I can have great trades that make me money, as long as the premise behind that trade is something that will make me money in the long run. So
Mm-hmm.
everything else I've done has worked great. I mean, I could just be like, hey, my biggest winner is Pinterest, which I think is
Mm-hmm.
true on the week. But I got lucky. I was long Pinterest, and I had happened to add some stock right before the news came out yesterday. No one was expecting that news. So
Mm-hmm.
sure, that's like maybe my best name. I did pretty well with Unity this week also, which has had a lot of news drama around
Mm-hmm.
it over the course of the last week or so. I did,
Mm-hmm.
I had one really good execution in that made me pretty good money in it. Um, but for me, that's just doing my job, and that's just going to be everything else. It's just the day in day out. Sure, every once in a while I'll have like one that I think is like an extra special spectacular trade that I'll want to remember or talk about in a really positive way. But
Mm-hmm.
for the most part, this business is about not making the chewy mistakes and just coming in every single day and just being disciplined over and over and over again. And I'll tell you, it's so hard. It's so hard to be disciplined 220 trading days of the year, every single one, and never make that slip up. But
Yeah.
that's what good trading is. That's where you give yourself an A for your trading for the week. And that's usually what I do when we speak. You say, Derrick, how's your trading going this week? And I'm going to go, oh, I give myself an A because I did everything I was supposed to do, and
Mm-hmm.
that's it. And on a week like this, I made a mistake. I didn't do everything I was supposed to do, so I can't give myself that same A.
Hmm. You say sentiment in the market right now is more neutral with the potential to go up or down based on, whatever makes that happen. What do you see as the possible next big catalyst for the market to either the upside or the downside?
It's a really good question, um, and I don't directly know. I'm paying attention to the technicals because we're in this range. Everything
Mm-hmm.
is so neutral. I when you have a neutral market, it's like you can flip a coin. So I would rather react after I'm seeing the technicals break as they are now, and maybe today is the catalyst. Honestly,
Mm-hmm.
it certainly looks like it when I'm looking at my daily chart on my other screen right now as we're having this conversation. I just see this big negative Maribozu engulfing candle on higher volume that causes to break a major level of support. This might have been it.
Mm-hmm.
Um, I have been calling for broadly since the end of August a range bound late August, September, and October, with always with the asterisks that a news event can change that thesis and can
Mm-hmm.
change the technicals. And that's the
Mm-hmm.
question. If we can snap right back again and hold this same 445-ish area that we've been, then I think we're staying range bound for a little while, and then maybe the supportive flows come into the end of the year that lead to either a grind higher or potentially even a blow off top at a certain point. Um, but the technicals are going to tell me what to do, and the fact that we broke support today is concerning in the way that we did it. There's a very real chance that the day after a Fed day, which is often a trend day,
Mm-hmm.
the market participants decide to buy us right back up and everything is hunky dory again. But until that happens, I would say that today might have been that catalyst.
Hmm. Okay, so what's your game plan heading into tomorrow morning?
So I have to leave early-ish tomorrow
Oh
for this
yeah,
flight to
you're
Las
traveling.
Vegas. Again, yeah, Market Mind
Yeah.
Summit. Hope this market holds in place while I'm in the air and have positions on. There was a time about a year ago, I was flying back from Spain, and all I had access to on that flight, the Wi-Fi wasn't working. I could get texts out, and I
Mm.
was texting T3's trade support team, and I was like, buy this, sell this, do this, manage this position for me. It was like so ridiculous. And that was also that trip when I got my computer got stolen in a
Mm.
car break-in Spain. So I have another video of me actually that my wife sneakily took where I'm like hiking up the side of a volcano on the phone with T3's trade support. like buy 2,000 shares of this.
Oh man.
It's really funny.
When
So,
you're like traveling and you have like looking at your positions disclosure, you have 1, 2, 3, 4, 5, 6,
18.
7, 8, 9, yeah, 18 positions open. Are you setting any like automatic stops on any of those just in case things go against you, or you don't use
Um,
automatic stops?
I don't necessarily use automatic stops. I probably will for a few of my positions, but not all of them. And I'll just have that stop loss in place. I prefer to monitor my positions and hit out when the trade's
Mm-hmm.
telling me that I'm wrong at this point on anything that's more than a day trade. If it's a pure day trade, then I'm in, my stop's in, my offers are out, whatever. If it's something that's a little bit bigger picture, it's like the area that I'm looking to hit out at. Like I hit out of a swing position that I had been in for a while in Roblox yesterday. Watched it real closely, and then I was like, okay, breaking through the area, and I just whacked a bit on my entire position. So yeah, it's a little bit hectic. I've been saying for years that one day I'll go on vacation and actually close out all my positions, but it's never happened. It's never happened. I bring the computer with me. I've traded, and this is one of the cool things. I think I love this. I have traded in so many places. I've traded in different countries. I've traded in different places throughout the United States. I've traded on the road, on the highway, off a hotspot. I've traded in a diner. I've traded in the parking lot of Hunter Mountain, New York, right before I'm about to go ski. Trading the pre-market price action right as I'm about to get on the lift.
Mm-hmm.
One thing I haven't done yet is actually trade on the ski lift, but
Mm.
maybe I'll pull that off this winter.
You just got to do it on your phone, right? Okay, I've been saving this audience question as a closing question because I think it's a great one. Ryan asked, "What do you enjoy most about working as a trader?"
Oh, I love what I do. I really do. I could never be stuck in an office staring at an Excel spreadsheet. What I love about this business is how dynamic it is. Every day is unique, and the market's a puzzle. It's my job to figure out that puzzle every day. I have to digest all this information. I have to keep in touch with the current events. I have to understand what's going on with different companies, with the market. I have to figure out a way for myself to be game planned around that thought process. The days go by sometimes almost too fast. People complain, "Oh, the days are so slow." I've never experienced that really while trading, even in those slower summer Fridays. I just genuinely and absolutely love what I do, and I love studying markets. I mean, this is the best. Every day is different. I really don't know what else to say about it.
All right. Well, Derrick, thank you so much for joining me for this today. I hope you have a safe flight to Vegas tomorrow and enjoy your time at the Market Mind Summit. For everyone who's still here with us, I'm putting a link in, or I'm putting a comment in the chat with a link for our next event. Andrew Moss, a professional trader with T3 Trading Group, also a chartered market technician, will be joining me again next week. He's been on in the past. So you can go ahead and register for that now. That link is there in the chat. And again, Derrick, thank you for doing this with me today. Hope you have a great rest of your night.
Thanks, Greta, and thanks to all the listeners. See you all next time.